Hello, everybody, and welcome to the BetaShares ETF 101 webinar series. We're really excited to talk about building better portfolios with asset allocation. Today, I'm going to be joined by David Bassanese, our Chief Economist, who will take us through the webinar. We're just going to give people a few minutes to join, and we'll get started in just a minute or so. Hello, everybody, and welcome to the BetaShares ETF 101 webinar series. Really glad to have so many people here to talk to us and listen about building better portfolios with asset allocation. My name is Ilan, and I'm one of the co-founders and head of strategy here at BetaShares, and I'll be taking you through and hosting this session. We've got a very, very strong attendance rate today, so it seems as though people are very interested to hear about a 101 series on ETFs and asset allocation. Just to get started, just to let you know, this information is general in nature, so it shouldn't be considered financial advice. Obviously, feel free to reach out to your financial advisor and read our product disclosure statement should you have any information about any of the products we are talking about today. From a housekeeping perspective as well, just to let you know, a recording of the session will be sent to all attendees, along with the slides that we are going through today. And also, you will notice that we have a widget, which is the GoToWebinar widget. If you have any questions throughout the session, please type them in the box, and we will endeavor to get back to you with the answers by the end of the session. We'll try to leave enough time to answer what we imagine will be quite a number of questions. So feel free to type those questions as we go, and we will answer them at the end, but you can type them at any time. Today, I'm joined by our Chief Economist, David Bassanese. For those of you who have listened to our webinars before, you'll know that he's a regular member of the webinar team. He's also our Chief Economist and has had an illustrious career, firstly as a journalist at the Australian Financial Review, where he wrote for about a decade a column, economic column regularly for the Australian Financial Review. He's also been at the Macquarie Bank and is also the author of a comprehensive guide to ETFs called the Australian ETF Guide. So today we will be talking about a bit of a 101 set series, which is what is asset allocation and why is it important? We'll talk about how ETFs can be used in the asset allocation process, and then David will take us through some asset class building blocks using ETFs. As mentioned, this is meant to be a relatively simple session and basic session. We run a variety of different webinars. This one, we've had a lot of people ask us to go back to the basics and talk about why ETFs are a useful way to build out an asset allocation framework, and David will be talking about that today. And so without further ado, I will pass on to David Bassanese, our Chief Economist, to take you through the rest of the session.
Thank you all. Thanks for joining us today. So in terms of the agenda, firstly, I'll talk about what is exactly asset allocation and why it's important. Then, again, just a quick refresh on ETFs and why we think there's, great benefit in using ETFs and particularly using them to build a diversified portfolio. And then, the actual building blocks, some examples of ETFs one can use to build, different asset class exposures right across one's portfolio. So let's get right into it. So the first part, asset allocation, and this is just a quote from Ray Dalio, some of you may have heard of. He's the founder of, I think it's the world's biggest hedge fund. So he's obviously a guru investor, but his take on asset allocation is you should have a strategic asset allocation mix that assumes you don't know what the future is going to hold, and basically what that boils down to is having another way of saying that is don't put all your eggs in one basket, essentially, because different things can happen in the world which will affect different types of investment. So you don't want to be exposed to any one type of investment such that if something specific happened, your whole portfolio would blow up. So you need to have that diversity to withstand the different shocks that do affect the economy, be it economic upturns, downturns, inflation, different country events, all that. So that's the key issue. Don't have all your eggs in one basket and try to get diversity across one's portfolio. And, the first building block for that is, and for example, many people do approach that saying, the old joke, oh, I have a diversified portfolio. I have 25% in ANZ, 25% in Westpac, and they own, 80% of their portfolio is the major banks. So that is, in a way, it's not very diversified portfolio because it's all, essentially you've got different banks, but it's all equities and it's all financial stocks. So, if anything particularly bad would happen to the financial sector, your portfolio would take a major hit. So that's an example where that's not real diversification. You're diversifying company-specific risk, but not diversifying away from the asset class. So what is an asset class? So let's just start with that question. So basically an asset class are investments, so securities. So imagine like an equity, a share is a security, a bond is another type of security. Owning a commodity such as gold is another form of investment, and a house is another form of investment. An asset class are investments that basically behave similarly. So they have similar characteristics. They tend to go up and down together at similar stages of the economic cycle, have similar levels of volatility over time. And so that's essentially it. So an asset class, and I'll go into it in a minute, it can be defined as securities that do behave, have similar properties in terms of their risk and return, and the periods in which they have good and bad performance over the cycle. And the beauty of, and the way I guess investors, approaching a diversified portfolio is to have a spread of exposures across different types of assets with different risk and return properties. So the key ones I'll be talking about today, just in terms of the next slide, really there are four key asset classes. Firstly, cash, just denoted there by the coins. Then bonds. So bonds are like a debt security. So when governments borrow money, they issue bonds where they agree to pay back a certain amount of money over time, and you get that regular interest payment on those bonds. And similarly, corporations issue corporate bonds as well. And so they are, in terms of the risk-return spectrum, you get somewhat higher return than you would from cash generally, but it's a little bit more volatile because the value of bonds tends to go up or down in line with changes in market interest rates over time. And again, I'll be talking a bit about that later. The other one is property. So again, we're all familiar with the residential property, but you can actually buy quite easily on the ASX exposure to commercial property as well. It's the AREITs sector. It's called the listed property sector. So things like, offices, factories, retail, the Westfields and whatnot, the retail shopping centres we all visit on the weekends. These are all asset classes available as well. And they, again, in terms of risk-return spectrum, you get a relatively more stable income payment over time. The volatility of their values is not as great as the equity market in general. And so it is defined as a somewhat separate asset class than equities, but because of because they do tend to behave somewhat differently to the equity market. And then the other one is Australian and international equities. So the things I think we're most familiar with, particularly Australian equities, and then also global equities. And again, I'll talk a bit about that soon. So if you just actually look at it, so the next slide shows the performances of these different asset classes historically going back to 2003. And so, look, the point to note is that, all assets have their time in the sun. They all perform, well at different points in time. If you look at Australian equities, for example, I mean, the volatility there, you've had big years, some gains of 20%, 30%, but then obviously most recently during the GFC, a decline of something almost 40% in 2008, sorry. So equities tend to be quite volatile, and you can see that there. If you look at the bottom line there, the minimum return, the weakest year had been a 38% decline. The strongest year was a 37% increase, and what's called a measure of the volatility year to year, the standard deviation is about 18%. Now compare that with bonds and cash. If you look at cash right down at the end, the maximum return in any given year was about 8%, and that was back in the days when interest rates were, the Reserve Bank had a relatively high cash rate. The minimum return is about 1.7, but the deviation or the volatility is quite low, only about 2%. The other point to note just from that is that the last line there is the correlation. I mean, you look at the correlation. These are the movement, how closely related. So when equities are doing well, do other asset classes tend to do well as well, or not? And if they tend to do relatively poorly, they have negative correlation. And so if you focus on the line there of correlation for Australian bonds, for example, it's got minus 0.72. So that means that when equities are doing well, bonds tend to do not so well because interest rates are typically rising in a strong economic environment, and bonds tend to weaken in that regard, and vice versa. Now, that negative correlation is a very nice property to have when you're holding, when you're trying to build a diversified portfolio, as I'll explain. So just turning over to the next slide. So what you want to do here now, so the asset allocation basically involves looking at each of those groups and treating them as an asset class and saying, oh, I want to blend my portfolio to have some equities, some bonds, some cash, and vary that allocation to basically come up with a risk return profile for the portfolio that you're comfortable with. Something that can generate as good a return as you could possibly hope, subject to having not too much risk. No more risk than you're prepared to bear. And by risk, I mean just year-to-year volatility in returns, and year-to-year possible down, total decline in the portfolio, for example, during bear markets. So there's really two aspects to that. So if nothing, or if you were to just blend bonds and equities, you could basically calibrate your risk. If you held all equities, that might be too much risk, and a high return but too much risk. If you held just bonds, you'd be getting a lower return typically on average, but very low volatility. Now maybe one is too risky and one's not risky enough. So what you want to do is come up with a blend of both, so that you get a portfolio they're happy with. And so that is the art of asset allocation, blending to come up with a portfolio that calibrates with your risk. Now, but again, the other benefit of blending is that you actually get an actual extra benefit from diversification, because when things are negatively correlated and you put them together, it actually helps to reduce the overall volatility of the portfolio without necessarily sacrificing a lot of return. And that's why I meant by the last point there, enhanced risk-adjusted return. That you can actually, through diversification, you can actually come up with a portfolio that generates a good return without generating a lot more risk. So it's a really much more, efficient, a very optimal portfolio outcome. Now, some examples of that in the outside of the investment world, just to help you get a sense of this. I've just come up with a couple here. Firstly, wine. I think this is a good example. Like, a lot of good wines are blended of different varieties. So, for example, a Merlot. I mean, look, I'm not a wine expert, but I mean, as I understand it, Merlot is typically a sweeter wine. And then at the other end of the spectrum, you have Cabernet Sauvignon grapes, which are a drier wine. Now, if people like very dry wines, they can go for a full-on Cab Sav. If they like a sweeter wine, they tend to go for Merlot. But if you want something in between, what you can do is blend the two and come up with something that is more suitable to your palate. So that's an example of using different types of grape varieties to blend to get something that ideally suits what you're after. And in fact, sometimes blended well, you can come up with a fantastic wine. There can be some Cab Savs which on their own are actually pretty bad, and similarly with a Merlot, but when blended together, you can come up with a spectacular result, and that's the art of wine blending. Just another quick example there is, for example, imagine two businesses, one selling ice cream and one selling hot soup, and so the ice cream maker does really, really well in the summertime, and the soup maker does really, really well in the wintertime. Now, if you were just own one business, it'd be feast or famine. You'd have 6 months of, great sales and then no sales, and vice versa. Whereas if you owned a little bit of both of those businesses, you actually smooth out your returns through the year. So you're getting a little bit during the summer from the ice cream maker, and a little bit in the winter from the soup maker, and it sort of reduces the overall volatility of your returns. And when you think about it, why is that happening? Because the returns on each of those businesses are negatively correlated. When the soup maker is doing well, the ice cream maker isn't, and vice versa. Without getting too technical, I just put that, I am an economist, so I do like my diagram. So that's just an example of what I mean, where you have two risks, like imagine a low risk asset, so by that I mean cash or bonds, and a high risk asset as in equities. And so blending the two, you can come up with a point along A and B. But again, when you get assets that are negatively correlated, you can actually come up with an even better outcome, something like C, where you can get even higher returns without adding a lot of risk. So just with the next slide, so this is how it really plays out in the investment world. So the first type of example, as I mentioned, is equity versus bonds. These are typically negatively correlated assets. And so by blending them, you can really, again, enhance returns and calibrate the risk to levels you would like. Another type of blend is using Australian versus international equities. And look, both tend to move together broadly over time. When conditions are bullish around the world, our market is typically doing okay, and so are international markets. But they can have periods where one area is doing particularly better than another. And again, if by blending exposures to both Australia and international, we can smooth out the ups and downs there. And I'll talk about that very shortly. So just an example then of that negative correlation I wanted to highlight with bonds. So this is a chart of annual returns for equities and bonds, and you can see equities generally have been quite volatile. Bonds returns not so volatile, and importantly, if you look at this, 2008, when equities had that big negative result, bonds actually produced quite a nice upturn. And that's because, again, during weak economic conditions, what tends to happen is interest rates tend to fall. The central banks are cutting interest rates, so yields on bonds tend to decline. And given they're paying out a fixed nominal amount of income over time, the value of those bonds in today's dollars goes up. So when interest rates decline, the market value of bonds tends to rise, and so you get a positive capital return from the bonds that you're holding. Just quickly if you look at bonds in more detail, you can decompose that total return into an income component and a capital component. And I just wanted to highlight there that yes, even within the volatility of bonds, the income component does tend to be pretty stable. And so what does move from year to year is just the capital value of the bonds. And so when you had that negative return, and when you had the positive return, it was really driven by a big capital appreciation in bonds because interest rates declined. But if you're holding them over the longer term and you keep collecting that income, that is a relatively stable component, which is true also for the equity market. You know, the dividend returns from companies is generally relatively stable, and it's the prices that are most volatile. So just again, I won't spend a lot of detail on it. I just wanted to show you the mathematics of this, where if you just look at a portfolio with two assets, so bonds and equities, and come with some reasonable return expectations. I mean, these are just assumptions. These are not necessarily my projections for likely returns, but it's broadly consistent with historical returns and what one might expect sort of over the longer run. So if you imagine bonds are returning, say, 5% a year, equities about 10% a year, and they have volatility of 3.5 and 15. So that's the volatility of those returns. If you had only held bonds, you'd get a return of 5%. And you'd have and given that risk, it would work out that you'd have you'd get a negative return on average about 1 to 2 years every 20 years. So pretty low risk of a negative return. If you held only equities, you get a higher return, but because of the high volatility, there's greater chance of negative returns in any given year. In fact, it's, on these calculations, something like 5 negative returns a year. Now, what I've got there is if you actually blend 50-50, you get a different combination of return and risk. And in fact, the returns you get are also then dependent on the correlation between equities and bonds. And as you can see, when equities and bonds are negatively correlated, the volatility of the portfolio for a 50-50 allocation is actually quite reduced. It goes all the way down to 10%. And in fact, you're getting a return higher than what you get from just holding bonds, but without not a lot more volatility. If the bonds and equities were more positively correlated, so they tend to go up and down together, you don't get that much benefit from diversifying and holding elements of both. So it's that negative correlation that really produces that extra return. And so that's really what you're striving to do, is try to come up with assets that do tend to perform well at different times of the economic cycle. And similarly, if you look at equities, I mean, one of the reasons why having a blend between Australian and international makes sense is because the sector compositions are quite different. So as you can see from this slide, Australia has very low exposure to information technology, for example, about 2% in terms of market cap, but very high exposure to financials. You know, looking at sort of 1/3 of the ASX is financial stocks, and the resources, materials about 18%. So we're heavy resources, we're heavy financials. whereas things such other indices like the United States, they have a much higher exposure to technology. And so in periods when technology globally is doing very, very well, as has been the case in the last few years, our market has tended to underperform and not do as well as global markets. Similarly, when we had the commodity boom between 2003 and I think 2013, up until the GFC, and commodity prices are rising strongly, Australia was doing pretty well. And so you can smooth that by having just a blend of exposures to the different markets within the portfolio. So, and just to highlight there that this is a chart of the Australian returns over time, and then the drawdowns of the Australian market vis-a-vis the world. You can see that generally when the global markets are selling off, Australia will also tend to sell off. So the correlation is positive, but it's not perfect. So, there are periods where global markets, for example, sell off, and actually during the tech bubble in the late 1990s, for example, global markets and technology sold off a lot. We didn't sell off as much because we didn't have a lot of technology exposure. So there's an example where that having some diversification does count. So what I want to do now is go through so I've mentioned equities, I mentioned bonds. Just the final building block of this is Australian cash, and just an example of the returns you can get from cash. So that's the RBA cash. Basically, if you look at the cash returns, it's basically very close to what the RBA official cash rate is, with a little bit of margin, because typically a cash return will be holding short-term bonds in the market or deposits, and they often pay a little bit more of a margin. But generally, it's pretty close to the cash rates. You can see returns were quite high earlier last decade when the RBA had a high cash rate, but more recently it's come down to only around 2% or so. But generally also you can see from that it's a relatively stable return over time, just tracking what's happening with the Reserve Bank. So just again, just an example of how you could blend three assets then, cash, bonds and equities, using certain return assumptions as I've got there. So 2.75% for cash, 3.25% for bonds, 9.5% for equities, and assuming a negative correlation between bonds and equities, and still negative but not as much between cash and equities. And again, I won't go through it in detail, but just to show you that for different, you can basically blend, by blending different elements of cash, bonds and equities, you can come up with different types of portfolios that have different risk return profiles. So for example, band 3 that has essentially 50% exposure to equities, on those assumptions you get a return of something like 6.5% and only have 3 negative return years on average every 20 years. Whereas if you wanted a lower risk profile, you wanted to have a lower risk of a negative return, you could go to something like profile 1, where only 15% of the portfolio were in equities. But as a result, you're also then getting a lower expected return. So again, it all comes back to risk and return, but the beauty of blending is that you can basically calibrate and decide where along that risk return spectrum you would like to sit in terms of your portfolio allocation. So just quickly on the benefits of ETFs before I do start talking about some. Again, BetaShares, we have about 50 exchange traded products now on the ASX, and they are typical managed funds. They basically pool investor money and invest in a range of securities, be them equities or bonds. The only difference from the typical managed fund is they are available on the ASX. You can just buy them, sell them as you would an ordinary share. As distinct from, say, a listed investment company, which are other types of managed funds that are available on the ASX or pooled investments, the ETFs are designed to trade near the net asset value. So you don't get the problems of big premiums and discounts to the underlying value of the securities that listed investment companies can be subjected to. So, for example, if you buy our NASDAQ 100 ETF, which holds a pool of securities or a pool of equities in proportion to their weights on the NASDAQ 100, and if the NASDAQ goes up by, say, 10% over a 6-month period, the market that you can be able to buy and sell that ETF pretty much close to that. The market value of that ETF should go up by pretty close to 10% over that period. which is, again, you can't say the same thing for a listed investment company, which may be investing in tech shares as well. Their tech shares could go up wonderfully, but there's no guarantee that the price of that LIC will go up at the same time. ETFs offer lots of investment choice, as just from the other slide. I mean, that's the other. Again, the big thing about ETFs nowadays, it's so much easier to get exposure to international equities in a way investors formerly couldn't. You could always get exposure to Australian equities on the ASX, whereas now you can buy international equities. Also, things like commodities, you know, gold, oil type exposures, international and bonds. You know, access to relatively lower risk type of investments and bonds. And that's a big innovation, which is opening that whole field to retail investors to get into that market. The other reason that ETFs are popular, of course, is just many active funds do struggle to beat their indexes. So most of the ETFs on the market tend to be rules-based, low-cost passive funds that just track different types of indexes, be them equity indexes or bond indexes. And often you find that most actively managed funds, or many, that charge, you know, higher fees, do at the end of the day struggle to beat that index. Very strong growth in the ETF industry in recent years, and again, regular listeners to our webinars would chart that progress. So we've had, you know, something like 40% annualized returns since the start of 2001, and the overall market now is approaching 50 billion funds under management, which, as a share of total funds, total managed funds in the country, is still a drop in the ocean, but nonetheless, it's been growing quite strongly. So what I want to do now in the time remaining is go through some specific examples, some specific ETFs available on the ASX today that can give you that asset class type of exposure. So first, in terms of cash and bonds portfolio exposures, I've got a list of different ones here. So we have a few funds, AAA, which is a cash ETF, basically invests in bank deposits. We have Coupon, which is a floating rate bond ETF, and invests in bank bonds, but the yield on those tend to vary in line with market interest rates. So the capital volatility of those bonds ends up being quite low. But because they are not deposits, are bank bonds, you're taking a bit of bank, I guess, credit risk when you invest in these bonds. You do end up getting a higher yield than you would from, just say, a cash ETF, even though the volatility of that return is not that much greater. Then we have a longer dated corporate bond, and I'll talk a bit about this in a minute, that's generating even a higher yield. So this is a bond return. And then we also have hybrids. So we have a portfolio that invests in a diversified range of hybrids on the market. So as you can see, all of those offering pretty, you know, certainly compared to the typical bank deposits. So if you look at like the average 1 month term deposit paying about 1.5%, our cash ETF offers 2%. You're already getting 50 basis point pickup there. And then if you want to go further along that bond spectrum, Coupon's offering, you know, just over 3% return, Cred just over 4%, and hybrids even higher still. And hybrids aren't a bond; they're a blend of both equity and bond characteristics, but they also offer a relatively high income return. So just to drill down into that a bit further. So this is the historic returns on our AAA cash ETF, and as you can see, it's typically offered you a higher margin than what the RBA cash rate has been, and more recently it's been about 50 basis points more. And again, very, very stable returns. So the way that fund operates is that basically every day incrementally the net asset value of that fund goes up in line with the interest that it earns, and then at the end of each month it pays that interest off to whoever happens to be holding that ETF at the time, and then the net asset value of that ETF then drops back down to you know, allow for the fact that an interest payment has been made. But it pays that interest return on a monthly basis. In fact, all these funds pay on a monthly basis. The next one is Coupon. As I said, this is a float. Again, in the interest of time here, I'm just giving you a very light taste of all these products, and I don't have the time in the half an hour or so to go in a lot of detail here. But if you do want more information on these, it's definitely all on our website. So I won't go into the details of what a floating rate bond is so much. Suffice to say, it's a slightly more volatile type of return over time, but in exchange for giving you a somewhat higher yield than you would get from holding cash. So it's a little bit further along the risk return spectrum, but still within that cash bond area. And as you can see, Coupon, the annual returns have kind of gone up or down depending on what's happening to the value of bonds. but the overall return has still been comfortably above what you get from term deposits over time. The other one is CRED. So this is a relatively new, but it's becoming an incredibly popular ETF for us. It's long duration fixed rate corporate bonds. And again, the beauty of bonds, of fixed rate bonds, is that when interest rate is the negative correlation with the equity market. When equities are falling, when economic conditions are weak and equities are falling, central banks are cutting rates, typically the value of bonds goes up in value. So you're actually getting, it's helping insulate your overall portfolio volatility. And just as a highlight here, if you look at the periods of equity market weakness going back to the GFC, and then we had 2011, the pullback in early 2018, and most recently late last year. And each of those periods where the equity market declined, CRED, our long duration corporate bond ETF, produced a nice, comfortable, positive return. And in fact, it produced an even stronger return than from something that's a more plain vanilla type bond exposure, something that's called the AusBond Composite Index. Again, this is an index that many I guess plain vanilla type fixed income ETFs provide exposure to. Problem with that AusBond Composite, it's at the moment it's chock full of government bonds, low yielding government bonds, and so the yield on that tends to be pretty low. And also the interest sensitivity of those bonds isn't as great as CRED because we tend to hold longer duration bonds. So just as an example, CRED is offering, at the moment just over 4% or so yield. The yield on the AusBond Composite, if you were to buy a plain vanilla fixed income ETF tracking that index, the yield is, barely more than 2%. So it's a big income pickup by holding CRED over AusBond. At the same time, at which it provides you as good, if not better, insulation in periods when equity markets are declining. It definitely has tended to historically. The last one in that area are hybrids, and I think this is just a highlight. I mean, when people talk about hybrids, they're always conscious of the risk. The thing about hybrids is when you hold a hybrid, the risk you are taking is the risk that whoever issued that hybrid could potentially become insolvent. And in fact, in those periods, those hybrids can be converted into equity, and if it turns out that there's not much equity there, they can actually get wiped out. So there is a risk in holding. You get more of a credit risk in holding hybrids than over bonds, because if in the case of a company going bankrupt, for example, hybrid holders will lose out before typical bond holders, so they're further down the credit chain. But in exchange for that risk, you are getting a higher return. And in a sense, it's a tail risk, because it's really a risk that only arises in the event that a company does become insolvent. And in which case, most hybrids in Australia, we're talking about the big four banks, and I'll let you decide what probability you attach to CBA, Westpac, and those companies becoming insolvent. But the beauty of it, as you can see, is in periods of equity market decline, yes, hybrids have tended to fall in value, particularly during the GFC, not as much as the equity market did. But that was at a period where bank solvency was briefly in question. But more recently, when equities have sold off, hybrids have really held, they haven't really sold off all that much. So you're actually getting, they have demonstrated more recently good downside protection vis-a-vis equities when equities are selling off. So again, it's another one to consider in the portfolio. In terms of equities, again, I'm running out of time here, so I'll just quickly touch on these. We have a couple of ideas here. One is our FTSE RAFI Australia 200 index. And again, it's an index fund that tracks the top companies in Australia, but it's weighted in a way that tends to outperform over time, or has historically outperformed the ASX 200, because the ASX 200 is a market cap weighted index. We weight by underlying measures such as book value, earnings, dividends, and cash flows. And as a result, we tend to not buy shares. We tend not to increase the weight to shares when they're going up strongly in price, because typically, you get these periods when shares become overvalued and undervalued, and a market cap index will basically increase the weight to shares as they're going up and increasing in value, even if that value is not justified. And so by not doing that, our fund tends to outperform historically over time. So it's a nice core way in which holding equities. At the other end of the spectrum, we do have a very plain vanilla market cap index. which is a market cap index. But the beauty of this one is it charges the lowest fee in the world, really, for Australian equity exposure. In fact, 0.07%. That's the A200 fund. So if you just want plain market cap exposure, something that is very close to or similar to the returns of the ASX 200, it's not exactly the same index, but it's a similar index. You can get that at a world-beating fee of only 0.07%. Then you've got listed properties. So again, we have a couple of exposures here. Well, the main one here is RINC. That's the code, RINC. And it basically gives you quite diversified exposure to both commercial property and utilities and infrastructure, such as toll roads, airports, these sort of things. So as you can see, compared to a typical listed property index, it's much more diversified. Then finally, to conclude with Australian equities, we have a quality index, which tends to do quite well. So it's companies with high returns on equity. And this gives you broad global exposure to Australian equities. The code is QLTY. And as you can see, historically, it's tended to beat the MSCI World Index. And it actually tends to do well during periods when equity markets are in decline. So that's a good way of getting global diversified exposure to international equities that have high return on equity. The other one is obviously something like the NASDAQ. And again, NASDAQ has historically done very well. And so the code there is NDQ, and that gives you exposure to, many of the top global tech companies around the world. And the beauty of that is these are the types of exposure that our market doesn't have we're very light on in terms of technology. The last one I wanted to touch on is gold. Again, the beauty of gold is that, again, it's another one that does tend to do well when equities are selling off. Not all the time, but generally in periods of equity market sell-off, you get a flight to safety, and then gold can do well. And in periods such as high inflation, for example, if that were to ever come back, then you'd expect gold to be doing well. So given it has low correlation typically with equities, it's an interesting one to hold in a portfolio. So look, wrapping all that up, and in conclusion, is just an example of what such a diversified portfolio would look like. So across all those different asset classes that I've mentioned, there are the different ETFs that one could use, blended in a way that is like what I would consider like a balanced fund. So it's 50% equities, 45% cash, bonds and hybrids, about 5% in gold. And if you look at the management expense ratio across all those ETFs, the weighted average fee is only 36 basis points in this example. So again, if you have a different risk profile, if you want higher exposure to equities, you'd obviously bump up the equity exposure, and vice versa. If you wanted a more defensive portfolio, you'd increase the bond part of it. But that's just an example. And again, everyone, it's for yourself or your personal financial advisor to decide what sort of risk profile is right for you. But this is just an example of how you can blend different types of ETFs and come up with a diversified portfolio. So with that, I thank you very much for your time, and I will hand back to Alan.
Thank you very much, Dave, for taking us through that very informative chat. We do have a lot of questions here. Just a few things to consider as well while we wrap up. Obviously, what we've been speaking about does have investment risks. So this is just a few bits and pieces for you to read on about, to describe the fact there are risks associated with any sort of investing. So look, we've probably got, I'd say, about 5 minutes just to try and answer a few questions that have come from the audience, and I'll just take us through some of those. I'll also just point out as well, before I do that, that we do have a variety of different areas where you can find out a lot more about ETFs. Our website is detailed. We've got webinars such as these ones. We also have, of course, our social media accounts and our regular newsletter. We've got an educational section on the betashares.com.au website, which you can look at in your own time. And we've got a course that a lot of people that are just getting started find very interesting, which is the ETF Basics Course. You can see there the actual URL, betashares.com.au/ETF-basics-course. It's a 6-part email course that's sent over 3 weeks, and it does include a lot of the basics of investing in ETFs. So please go ahead and sign up for that if you would like to learn more about investing in ETFs. Now, with that said, I will go and back to some questions. So I suppose just very basic questions here. One question is how often an investor should be adjusting their asset allocation in their portfolio. So I'll just hand over to Dave to answer that one.
Hi. Yeah. Look, just look. Again, what I've been talking about today is strategic asset allocation. This is like a longer-term, portfolio. So I haven't really talked about, the idea of tactical. Should you be particularly overweight equities compared to what you would average on average hold given this, stage of the cycle. This is really a bedrock, what's called a strategic asset allocation type portfolio. But within that, I mean, look, there's no hard and fast rules as to when you would rebalance, but what I would suggest is a good rule of thumb is something like at least annually. And one of the benefits of being of an annual rebalance is you tend to fade the asset classes that have done well. So you kind of find that within a year, momentum tends to be positive. So if an asset is doing well at the moment, it typically can do well for a number of months. So you actually benefit from some positive momentum. And you reduce your trading costs if you don't try to rebalance too frequently. But typically after a year or so, things that have been doing very well then tend to correct back, particularly if they've gone too far too hard. And so by rebalancing, you actually then sort of fade that. So for example, if equities have done very well and you find that you are now somewhat overweight equities relative to what you were, a year or so before, by rebalancing and reducing your exposure back to, say, a target weight of 50% in equities, you're actually selling some of your equities when they've been up and been relatively expensive. So as a rule of thumb, I would say, something annually would probably make sense. But again, that's just a general rule of thumb.
Another question that people have asked is about the liquidity of ETFs. So how easy will it be to sell ETFs during a stressful market? It's obviously a very common question we got. If you wouldn't mind answering that one.
Yeah, hi. Look, it's a very common question. The first thing, most of these ETFs that I've talked about today, I mean, the key with an ETF is that they're generally investing in very liquid underlying securities. And so in an event where there's like a lot of investors decide to sell, basically what would be happening is a lot of ETFs would be sold back to the market. The underlying traders who manage that ETF on the market for us will basically then sell the underlying securities. I'm summarizing here, but they basically end up selling the securities and then being able to, effectively, give money back to investors that way. So it is easy to do, but what I would say is, you need to be careful in what can happen is that if you sell in a period of high volatility and you well, in fact, before I get a bit more detail on this, I think we do have a response to this that we might put up on this, because it can get a bit complicated to talk about selling intraday. I mean, what you don't want to do is just put out a big order. This can happen at any time. If you put in a big order and you just want to sell irrespective of price, it happens even in individual stock. You can get a bad fill, and that you can get you're no guarantee of getting what the net asset value is of that ETF. So you just got to be careful when you are selling. But that is just a feature of the way in which people do sell any stock on the market. But the important point is that you should be able to get in and out of ETFs pretty easily at close to NAV when managed carefully. Because the underlying securities, be them shares or bonds, are very, very liquid.
All right, I'll just ask two more, and then we'll have to wrap it up there because of time. We'll obviously try to get back to other people by email or another form in the future. So two questions I'll ask, and you can answer both of them. One is around hedging. When one should consider, what are your views on hedging currency? So should you buy currency hedged or non-currency hedged ETFs? And also, what would somebody look at if they had a lot of US exposure and was looking for something that wasn't that correlated to that, but offers a reasonable amount of income? Those are the two questions I've had.
So just on hedging, it's really horses for. I mean, hedging in a way is a tactical decision in a sense. I think from a long-run strategic point of view, it shouldn't really matter too much whether you're hedged or unhedged. Because the Australian dollar, has been broadly stable, in recent years. So I don't think it's really, if you think over the next few years the Aussie dollar is going to go up a lot, for example, then you probably, you'd want, and if it does go up, then you'd want to be when you hold securities unhedged, you're going to lose out. So you want to sort of be hedged in that situation. So it's really a currency, your view of the currency, whether you should be hedged or unhedged. But as a general rule, I think if you had to choose for a set and forget long run portfolio, I would suggest probably having unhedged. Typically, the asset class, when you talk about international equities, it's unhedged because it just adds that extra level of reduced correlation with the Australian market. So unhedged, and that way, if the Aussie dollar goes down, the value of your international securities tends to go up, and vice versa. And you'll find most broad, there are both hedged and unhedged global equity funds on the market, and some of ours are hedged and unhedged as well. But I don't think it's really, I think the most important question is what type of market you want to be in. Is it broad, diversified market, a specific country, a specific sector? But from a broad point of view, if I had to choose and I want a broad equity international exposure, I would say unhedged. The other one in terms of income, look, if you want, the beauty, again, I think with the possible changes in franking credits, this has become more and more interesting, and people now seeking income. What if people can no longer benefit from franking credits on the Australian market, it's an opportunity now to say, well, I might as well get some diversification by investing offshore. And so one example of something you could look at is Inc. We have a global high income equity ETF, INCM is the ticker code. If you type that into your share account, that would come up. And basically what that is, a global diversified range of companies that tend to have above average dividend yields, and they're actually screened in a way that we think they probably have the highest, most sustainable dividend yields likely in the market. So at the moment, the yield on that is around about 5.5%, which is again fairly comparable to what you can get on the Australian market. But the beauty of it is, again, you don't have all your eggs in one basket.
Well, thank you very much, everybody, for that, and David for taking us through the webinar. As I mentioned, everyone will receive a copy of this presentation and a recording, and we look very forward to bringing you more ETF 101 style webinars throughout the remainder of the year. And of course, do sign up to our newsletter and courses should you like to know more. And of course, you can give us a call or email us anytime should you like more information on what we've spoken about today. With that, have yourselves a great day, and we will be back with you again in the future. Many thanks. Bye-bye.